In 2008, the world economy nearly collapsed. Banks failed, millions lost their homes, and governments spent trillions trying to stop the bleeding. But to really understand how we got there, we have to rewind the clock, back to the 1990s, when President Bill Clinton and other policymakers made big changes to America's banking laws. Today, we're asking, how did Clinton's deregulation, along with Andrew Cuomo's housing policies, help set the stage for the worst financial crisis since the Great Depression? To get why Clinton's changes mattered, we need context. After the Great Depression, Congress passed strict banking laws, especially the Glass-Steagall Act of 1933. This law separated traditional banking, like savings accounts and loans, from risky investment banking, like trading stocks and bonds. Why? Because in the 1920s, banks gambled with people's deposits, and when the bets failed, the whole system collapsed. Glass-Steagall was meant to prevent that from happening again. For decades, it worked. But by the 1980s and 1990s, big banks wanted more freedom to merge, expand, and chase profits. They argued these old laws made them uncompetitive in a global market. Enter Bill Clinton. In 1999, he signed the Gramm-Leach-Bliley Act, also known as the Financial Services Modernization Act. This law effectively repealed Glass-Steagall. Now banks could combine traditional banking, investment banking, and insurance under one roof. For example, Citigroup merged commercial banking with insurance giant Travelers, something illegal under Glass-Steagall, but fully legal after Clinton's signature. Clinton later defended the move, saying deregulation didn't cause the 2008 crisis. But critics argue that it allowed banks to become too big to fail, giant financial supermarkets that gambled with deposits, and when they lost, taxpayers had to bail them out. Another Clinton-era change was the Commodity Futures Modernization Act of 2000, which kept financial derivatives, like credit default swaps, largely unregulated. These derivatives became central to the 2008 meltdown. But Clinton-era policy wasn't just about banks. It was also about housing. In the late 1990s, Andrew Cuomo, then Secretary of Housing and Urban Development, HUD, pushed to expand homeownership, especially among lower-income families. HUD raised the goals for Fannie Mae and Freddie Mac, the government-sponsored mortgage giants, to buy more loans made to borrowers with weaker credit. The idea was noble: give more Americans a shot at the American dream. But it also encouraged a rise in subprime lending, riskier mortgages, to people with less ability to repay. By the early 2000s, banks were packaging these loans into mortgage-backed securities, selling them worldwide. So, Cuomo's policies, combined with deregulation, helped create a system where risky loans could be made, sold, and insured, all with very little oversight. Let's connect the dots. Clinton's deregulation let banks merge and grow enormous. His administration also made sure derivatives stayed in the shadows, without oversight. At the same time, Cuomo's housing policies boosted subprime lending and expanded the role of Fannie Mae and Freddie Mac. Banks now had the freedom to bundle risky mortgages into complex products, sell them to investors, and bet on them using derivatives. As long as housing prices kept rising, it seemed like a win-win. But when the housing bubble burst in 2007, the whole chain unraveled. Mortgage defaults skyrocketed, mortgage-backed securities collapsed in value, and derivatives amplified the losses. By 2008, Lehman Brothers failed, Wall Street was in panic, and the global economy entered freefall. So, how much blame falls on Clinton and Cuomo? The answer is complicated. Many other factors played roles: Wall Street greed, Ratings agencies rubber-stamping junk securities as safe, the Federal Reserve's easy money policies, and weak regulation under later administrations. Still, it's clear that Clinton-era changes gave banks more power and freedom, while Cuomo's housing push made risky lending mainstream. Together, they laid the foundation for a fragile system that collapsed when stress hit. The 2008 crisis wasn't caused by a single law or person. But when you trace the story back, Bill Clinton's banking deregulation and Andrew Cuomo's housing policies are key chapters in the story. It's a reminder that decisions made in times of prosperity can have consequences that echo for decades. So, was the 2008 crisis born in the 1990s? That's for you to decide. Please like and subscribe. And while you're at it, click the notify bell so you can know what's new. Comments are always welcome, as well as ideas for future videos.